Hi everyone, this is a technical analysis on USDJPY. Let's start with some fundamental background first. On the US side, the Fed hiked by 25 bps as expected and kept everything unchanged. Fed Chair Powell reaffirmed the data dependency and kept all the options on the table. The US economic data keeps on surprising to the upside, but inflation expectations and CPI readings continue to show disinflation with the last two core CPI month-for-month figures coming in at 0.16%. The US PMIs this week missed expectations across the board and broke down Treasury yields, weakening the US dollar. But the US jobless claims yesterday came out better than expected once again and supported the USD across the board. At the moment, the market doesn't expect another hike from the Fed, but the next NFP and CPI data will be crucial to confirm or change this view. Moving on to Japan, the BOJ kept everything unchanged as expected, but implicitly tweaked the yield curve control policy, keeping the target band unchanged, but giving more flexibility with a hard cap at 1%. They basically widened the yield curve control band without stating it explicitly. This has created lots of volatility in the JPY, but eventually led to a fast appreciation. The BOJ has also already intervened twice to smooth the rise in yields, ultimately weighing on the JPY. Last week, the Japanese CPI data surprised to the upside with the core reading, reaching again the previous high. Today, the Tokyo CPI, which is seen as a leading indicator for national CPI, missed expectations, but the core reading matched the prior figure, remaining well above the BOJ's inflation target. Now, on the daily chart, we can see that USD/JPY started to consolidate just above the broken high at the 145 handle. The pair remains firmly in an uptrend as the price keeps printing higher highs and higher lows, with the moving averages being crossed to the upside. The market might be waiting for some fresh catalyst for the next major move, so paying attention to the data will be key. Drilling down to the 4-hour chart, we can see that the price has been diverging with the MACD for a long time. This is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, we got a pullback into the 145 support zone, where we had also the confluence with the 38.2% Fibonacci retracement level. The buyers piled in here with a defined risk below the support zone to target a new higher high. On the 1-hour chart, we can see that we have a top trend line that is acting as resistance. This might turn into a bullish flag pattern, so a break to the upside should see more buyers piling in and take the price to new highs. The sellers, on the other hand, might lean on this resistance to position for a downside move into the 145 support zone, and then pile in even more aggressively in case the price breaks through the support. Today, the only major event is Fed Chair Powell's speech at the Jackson Hole Symposium. The expectations, though, are for him to take a wait and see approach as we have more key economic data ahead before the next FOMC meeting.